Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
G'day, welcome to the 2 Cents episode of the Australian Property Podcast. I'm Pete Wargent from Allen Wargent Property Buyers. Just me this week. Chris is off on his well-earned holidays, having a well-deserved break. So today I'm just going to talk a little bit about my top 3 property investment tips for 2025. I'll do a quick review of 2024 as well. Don't have many notes to hand, so it'll be a bit freestyle and might be a bit rambling at times, but it will be real. So let's get into it. So I guess 2024 was a fascinating year. I think if you'd have asked a lot of people at the beginning of the calendar year how things might have gone, given the trajectory of interest rates, they would have probably expected the housing market to be weaker than it actually proved to be. I think the main issue was a combination of high immigration, extremely low rental vacancy rates, rising rents in many parts of the country, including capital cities and regional markets. And some cities performed exceptionally well with the real chronic supply shortage. We're just not building enough new homes at the moment. So even though mortgage rates went up, and for a lot of people, they're paying interest rates of around 6.5%, now much higher than they were 2 years ago. Some very strong performance, particularly from the Perth property market. A lot of people would have seen the price of their property up, say, 30% in 2024. Lots of parts of Brisbane and Adelaide performed really well. I think towards the end of the year, though, we did see in the bigger cities, often where people have bigger mortgages, and in Melbourne's case, where the economy has been struggling a little bit more, the property market really ran out of steam towards the end of the year. And that's in spite of the high population growth, in spite of the tight rental markets and supply shortages. So maybe it's just a question of a bit of a lag effect. Interest rates did ultimately do what they were expected to do, but maybe it took longer than expected because of that imbalance between supply and demand. And interest rates have generally stayed higher through 2024 than a lot of people might have expected. I think the other very pressing issue for Australia's property market and the economy in general is the sheer expense of constructing a new dwelling. There's been a bit of analysis. I followed the ABS figures. I saw Michael Matusik on his excellent blog talked about the change in new dwelling construction costs. Cameron Cusher from PropTrack, as part of the REA group, did the same thing, put together a couple of very interesting graphics. And what has really happened since March 2020, the average new house is now 43.6% more expensive to build than it was those 4 years or so ago. For townhouses, 43.7% increase. But the real interesting one has been apartments. There's been another massive increase in new dwelling construction costs for apartments in 2024, another 19.4%, taking the cumulative change in new dwelling construction costs from March 2020 to October 2024. Just checking the number here. It's, would you believe, it's 73%. So an extraordinary increase in the cost of constructing new apartments per unit. It's now $604,000 on average to supply just a box, a new apartment to the housing market. So in that context, it's maybe not that surprising that a lot of developers are effectively sitting out this property market cycle. Not so much potentially in Perth or Brisbane or Adelaide, where the price of established dwellings has increased significantly. But if you look at Melbourne and especially Sydney, there just isn't really that profit margin there for developers to get interested. There's been a lot of insolvencies, about 3,000 developers and construction businesses have gone bust or fallen into administration or insolvency over the past 12 months. But have a think about that. 73% increase in new dwelling construction costs for apartments. So I think in 2024, we might see a bit of a rebound in activity of construction in some of those cities where prices have gone up. Maybe to some degree in Melbourne as well, with the stamp duty exemptions coming into force. That might just create a bit of a spurt of activity. But particularly for Sydney, that does look to be ground zero for the supply shortage of new apartments over the next 2 to 3 years. Anyway, on to my top 3 property investment tips for 2025. So the first one is to aim to turn yourself into a property pro or a professional. I recently went to a live event in Brisbane. I went to see Chris Williamson, who's a fellow Englishman from the Modern Wisdom podcast. He's a fantastic podcast. I think it's now the second biggest podcast in the world, I think, after Joe Rogan. Self-made Northern Englishman with some very deep insights and some brilliant content, really. And I went to Fortitude Music Hall in Fortitude Valley with my business partner, Andrew Freed, who some of you may know. And brilliant content as always, and good to see the live event. One of the key takeaways for me was a book recommendation that Chris made called Turning Pro by an author, Stephen Pressfield. And I was recently on a long haul flight. I had 14 hours to kill. So I got the audio book of Turning Pro by Stephen Pressfield. And while it mostly targets creatives and artists like, I suppose, authors or musicians, a lot of the messaging in that book really hit home. I think ultimately, when you think about investing in property or, in fact, managing your stocks and shares, you're effectively managing an investment business. So in effect, you should aim to treat it accordingly. Now, I think there's another thing that Chris touched on in the show is that you've got two different, ultimately, personality types. Some people who are very action oriented and other people who maybe overanalyze things too much. And I think you do need to take into account your own personality type. So some of us, for example, myself included, are not really detail oriented people. So making a highly detailed budget or spending plan, it's probably not for everyone. And realistically, it's not something that somebody like me is going to do. I have a short attention span. I like travel. I've got a couple of kids and a wife who like to travel with me. Pulling out a very detailed budget for 2025, it's something I could do, but realistically, my plans change on a dime sometimes, and I end up going to Spain or Vanuatu, and there's a lot of things in the course of a year that I wouldn't necessarily easily be able to budget for. Moreover, for somebody like me, it would be probably a bit boring, but nevertheless, I should probably take a professional approach to mapping out an investment strategy for the next decade at least. So what does that mean in practice? It probably means something like a 10-year property plan with a balance sheet and a P&L effectively, or cash flow analysis by property. I've noticed over the past dozen years or so, some of my most successful clients have been people who take massive action, but also those people who are really across their strategy, the cash flows, the returns on their investments, and so on. Now, I suppose there is another personality type, and that's the person or personality of the person who is over analytical and never takes any action for fear of doing the wrong thing. So for that personality type, you probably don't need to do more in terms of a detailed approach. In fact, if anything, it might lead to analysis paralysis. So I think you do need to bear in mind your personality type. I think for somebody like me, who's always been very keen to take action, but sometimes can do things on a whim or without necessarily thinking through long-term implications, I think taking a more professional approach to property investment, and for me as well, I guess in terms of content creation, like my daily blog and my podcast and so on, there's definitely a whole lot more I could do much more professionally, and certainly on my social media, I definitely could. So just to summarize some of the things I picked up from that audio book, I think a lot of us are afraid to truly embrace our true calling, as the author calls it in the book. And instead we get sidetracked and we pursue shadow callings instead. And I think the main message of the book is that the difference between an amateur and a professional is really in their daily habits. An amateur has amateur habits, a professional, as you might expect, has much more professional habits and a more professional approach. And he sort of explains that turning professional is a bit like kicking an addiction or a habit, and it's a decision that you need to recommit to. So as a property investment tip number one for 2025, I would say aim to turn yourself into a property pro. Take a more strategic approach. I'm definitely going to implement this myself. I think at various times I've sort of been very keen to sort of do something and take action, but not necessarily with an overarching strategy. And I certainly don't maintain very close, detailed records of the returns on my investments and so on. I think I could do better there. So on to the second property investment tip. And this one is quite simple. It's really just to book a call with a broker or a lending professional. I think it was Michael Yardney who I first heard say that property is a game of finance with houses in the middle, which is a bit of a trite phrase, but it's actually increasingly so since 2014, I think, given the changes in lending regulations. I think ultimately the amount of money that an individual can borrow, or the amount of debt that an individual can borrow, is now effectively capped at a multiple of your income. And it's not true for everybody. There are ways and means of extending your portfolio, especially in other countries. But for a lot of people, and for most people, there's a maximum amount of debt or mortgage balance that they can carry. And we've been through a pretty unusual period for lending. If you think in the Banking Royal Commission in 2019, had a big credit squeeze. We've seen macro-prudential changes to the treatment of interest-only mortgages, for example. Some people use trust structures, others invest as individuals. And then we saw interest rates falling to unprecedented lows, and they've now rebounded, as I mentioned earlier, to what is effectively a contractionary setting for the Australian economy. So many borrowers are now paying more than they need to, higher mortgage rates than they may be able to achieve, as banks are aiming to claw back returns from some of those lockdown periods when people took mortgage holidays and so on. Lending assessment buffers are currently very tight, 300 basis points. So in plain English, if you're taking out a new mortgage today at, let's say, 6.5%, the lender will most likely be stress testing you to see whether you can comfortably make the repayments at a mortgage rate of 9.5%, even though money markets are pricing for lower interest rates over the next 18 months, maybe of around 3.5% cash rate target. Lenders are still stress testing you for big assessment buffers. Now, this doesn't always apply to somebody who's refinancing their mortgages. So it definitely might make sense if you've got an existing portfolio to have a chat to a broker or your bank or your lender. Make sure you're getting the right mortgage rate, the best mortgage rate that you can. For some people, they might want to think about a refinancing, maybe to take a line of credit, get some buffers or offsets in place, and try and think a decade ahead. I think what you really should be thinking about is having a strategy which makes you unbreakable. There's an old saying that to finish first, you must first finish. If you've got a strategy that risks you running out of money or going into mortgage arrears or not being able to keep up the repayments, well, that's not an unbreakable strategy. And that's what you really need to avoid. So, yeah, have a chat to a broker, get the requisite buffers in place in case you need to take a sabbatical or there's a period of time when you can't work, and have a think about the next decade and making sure you've got the appropriate borrowing strategy in place for your portfolio. And thirdly, and finally today, my third investment tip is to try and think, trying to think of a better way to phrase this, but to think in decade-long chunks of time, if you like. You'll find that online media commentary these days, of course, is very focused on getting clicks every day. But a full property market cycle might take, let's say, 7, 8, maybe 10 years to play through. So what happens over the course of a week probably has very little bearing on the prospects of your property investment or your portfolio over, let's say, a decade time horizon. Our key investing years for most people, particularly in property, might be somewhere between the ages of, let's say, 25 and 65. So maybe about 3 or 4 decades potentially. Of course, you can continue investing deep into retirement these days, and your investment horizon might be much longer. If you think about Charlie Munger and Warren Buffett investing almost up to the age of 100, and maybe longer in Buffett's case. But the key investing years for a lot of people are often those peak earning years in your 20s, 30s, 40s, and so on. But that could be even still close to 4 to 6 property market cycles, and if not more, if you invest in different cities and states and countries. So if you're aiming to invest over that kind of time horizon, then almost by definition, you're going to get summer and winter seasons. So you'll see periods of high inflation, low inflation. There'll be, well, as we've seen over the past 3 or 4 years, we've had periods of very low interest rates followed by much higher interest rates. We'll be seeing over the next decade periods of undersupply over the next few years, but then we'll get a period of overbuilding. So corresponding from that, we'll have periods of low vacancy rates, as we're seeing now, and high vacancy rates. So in that context, you need to think about long-term fundamentals. If you're investing in a location, for example, a landlocked city location, you need to be thinking about the fundamentals for household incomes over a decade, where ideally you might see incomes rising by, say, 40 or 50% over the course of a decade. I don't think you need to get too bogged down in the daily or weekly news cycle if you're going to be investing over these long periods of time. And ideally, I think a decade is a good kind of time horizon for a lot of people. I think, of course, you can project out property portfolio returns for 20 and 30 years. But in my experience anyway, over much longer periods of time, life gets in the way. Plans can change. You might have a change of circumstance or relationship or family makeup. You might change country or location. But if you're thinking at least in terms of a decade time horizon, that's probably a healthy way to think about property investing rather than getting too bogged down in the day-to-day news, because there's a lot of it these days, and much of it is designed to generate clicks and eyeballs in front of adverts, and it's not necessarily going to help you if you're aiming to generate returns over 10, 20 plus years. So just to wrap up for today, it's been a very interesting time for property investment. 2024, as I mentioned, saw record household wealth for Australia, about $17 trillion. The aggregate wealth in Australia is just humongous these days. And I think people very often underestimate the sheer depth of household wealth in Australia. We've got record housing stock prices, record stock markets, December 2024, superannuation balances as a corollary of that, record highs. Looking ahead to 2025, we're still going to have high population growth in Australia, about 1 additional person every minute. So that's about, my mental arithmetic is any good, somewhere between 500 and 550,000 extra people per annum. I think that figure might slow down as the year goes on, but nevertheless, we're definitely going to see a chronic housing shortage in 2025 and probably for a couple of years beyond that. If you look at money market pricing for the next 18 months, markets are pricing for falling interest rates, which have historically always been a tailwind for the property market. And these are all strong fundamentals for property. But as I mentioned earlier on in the chat today, as with every decade, there'll be a period of undersupply, but then later in the decade, we'll get some overbuilding, particularly I think of defective high-rise apartments in a lot of higher density locations. And as is the case, I think with every decade, there'll be those who succeed with their property investment goals, and there'll be those who fail to progress as they might have hoped. So I think the best way to ensure that you're in the former group and not in the latter group is, well, firstly, by taking that more professional approach to investing, particularly to managing risk in the current environment, taking a sensible approach and having the appropriate buffers in place, and also just to think in decade-long cycles. I think very often you see people pull the trigger on a property investment, and then within a year or two they kind of lose faith because they never really thought through what the strategy was in the first place. So I think 2025, if you look at the fundamentals, will probably be a pretty strong year. I think bank lending competition will pick up. Maybe those lending assessment buffers will be reduced down to maybe 2.5 percentage points. We've got still high population growth, and a lot of developers just aren't building the volume of apartments to get the housing supply moving. So there's a lot of, I suppose, upside or pros for property investment over the next year or two. But as I mentioned, I think it's a good time to get a property plan in place for the decade ahead. So that's about it for today. Those are my 3 property investment tips for 2025. As always, if you want to have a chat, mortgage broking tips, Chris will be back on deck in the next week or so. So Chris Bates is always available with his team for a chat. If you want to get some advisory from myself at Allen Wargent Property Buyers, we do 10-year property plans. We also help with our buyer's agency service. And that's it for today. So have a wonderful Christmas, New Year break. Looking forward to getting back on deck with Batesy when he gets back from his trip to regional Australia, and looking forward to an outstanding 2025. So have a great weekend, everyone, and we'll see you soon.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.